Things are about to get ugly in the US real estate market, and no, you don't have to take our words for it. Warren Buffett thinks the same too. Warren Buffett, a billionaire investor, is sounding the alarm about a looming crisis in the US real estate market. He believes we're facing the consequences of a massive debt-fueled bubble, which he describes as a $1.4 trillion debt-fueled tsunami. This warning comes amidst concerns about the sustainability of the current real estate market, especially as property prices begin to decline. Buffett highlights the issue of bad loans held by American banks, particularly in the commercial property market. The commercial real estate market in the United States is navigating some choppy waters, especially when it comes to the issue of bad loans held by American banks. Let's break down what's happening. First off, the reserves that banks typically keep as a safety net against loan losses have fallen below the amount of delinquent commercial real estate debt. That's a red flag right there. Late payments on commercial mortgages have been on the rise, with major banks now holding a hefty $9.3 billion in delinquent commercial real estate loans. What's even more concerning is the sheer magnitude of the problem. The volume of commercial mortgages that are at least 30 days late on payment has actually surpassed the total reserves held by the biggest banks in the US. That's not a good look. Banks like Bank of America, JP Morgan Chase, and others have seen their reserves drop significantly, leaving them more exposed to potential losses. And it's not just one sector feeling the heat. Delinquencies on loans tied to offices, malls, apartments, you name it, have more than doubled in the past year. The amount of delinquent commercial property debt held by top banks has nearly tripled, reaching a staggering $9.3 billion. Overall, delinquencies on commercial real estate loans have spiked from $11.2 billion to $24.3 billion for the entire banking sector. Now, throw in some market uncertainty for good measure. There's over $900 billion in commercial real estate debt maturing this year alone, and billionaire real estate guru Barry Sternlicht is predicting a whopping $1 trillion in losses on office properties. No wonder the commercial property concerns have been sending shockwaves through the markets. The Federal Reserve is keeping a close eye on all of this, making sure banks have the right provisions in place and enough capital to weather the storm. With decreased demand for office space and interest rates on the rise, commercial property valuations, especially in the office sector, are feeling the squeeze. So essentially, the bad loans lurking in the commercial real estate market are posing some serious challenges for banks, and regulators are staying on high alert as the sector navigates through these economic uncertainties. When asked about Berkshire's involvement in commercial real estate, Buffett explains that Berkshire Hathaway, his conglomerate, hasn't historically been heavily involved in this sector, which is true for the most part. Warren Buffett and Charlie Munger, the dynamic duo behind Berkshire, have made a habit of steering clear of real estate on a large scale, despite dipping their toes into small-scale real estate financing adventures. At their 2002 annual shareholder meeting, they opened up about their aversion to this asset class. Buffett, ever the value investor, pointed out that most developed real estate tends to be accurately priced most of the time. Translation, it's rough for them to find those juicy, undervalued gems they love to snap up. And hey, hindsight's 2020, right? The historic overpricing of the US housing market leading up to the 2008 financial crash kind of proved his point. But why is real estate so darn accurately priced? Well, according to Buffett, it's all about fierce competition. The methods for valuing commercial real estate in big cities are pretty much the same across the board. Everyone's using the same playbook, making it a bit of a challenge to find those hidden bargains. Now, when do the real steals come out to play? According to Buffett, it's usually when chaos hits the real estate financing scene. Think of it like a fire sale. When nobody's rushing to invest, that's when the real deals start popping up. But those situations are about as rare as a unicorn sighting. Munger chimed in, highlighting another key reason why Berkshire stays on the sidelines of real estate. They're just not built for it. They don't have any special insider knowledge or advantages in the real estate game. And to add insult to injury, investing in real estate as a corporation like Berkshire means dealing with a pesky layer of corporate taxes, making it even less appealing. So to sum it up, Berkshire shies away from real estate for two big reasons. They're not bringing anything new to the table in a market that's already pretty packed, and the tax setup doesn't exactly make it a walk in the park. Instead, they're content sticking to what they know best. And hey, it's hard to argue with that logic. But the fact that Warren Buffett is not a major player in the property market does not take anything away from his warnings about the future of the real estate industry. Not only is he predicting the housing crash, he also explained how the market found itself in this mess in the first place. According to the avid investor, over the past 15 years, the US real estate market has been fueled by an abundance of cheap debt. This means that interest rates, which play a big role in determining the cost of borrowing money, have been at historically low levels. For example, the effective rate of US federal funds, which reflects overall interest rates in the economy, has hovered around 0% for much of this time. Low interest rates then encouraged individuals and investors alike to take on large amounts of debt to finance real estate purchases. Let's break down how this works with an example. Imagine someone wants to buy an office building for $1 million. They likely don't have $1 million sitting in their bank account, so they'll take out a loan from a bank to cover most of the purchase price. In this scenario, let's say they contribute $350,000 of their own money, equity, and borrow the remaining $650,000 from the bank. The profitability of this purchase largely depends on the interest rate of the loan. If they secure an interest-only loan at 5%, they would need to pay $32,500 each year in interest payments to the bank. As long as the income generated by the property, net operating income, exceeds this amount, the investment remains profitable. Banks assess the property's ability to cover its debt payments using a metric called the Debt Service Coverage Ratio, DSCR, which measures the property's income relative to its debt obligations. However, the problem arises when interest rates rise. Unlike residential mortgages with fixed interest rates, commercial property loans typically have adjustable rates that reset every few years. If interest rates increase, so do the borrower's debt payments. This can become particularly challenging if the property's income decreases, such as in the case of declining demand for office space due to remote work. In our example, if the interest rate rises to 7% or 9%, the higher debt payments may exceed the property's income, leading to financial distress for the owner. If they can't afford to make the payments, the property could go into foreclosure and the bank may sell it at a loss. This is what Warren Buffett meant when he said, "The buildings don't go away, but the owners do." It illustrates how changes in interest rates can have significant consequences for real estate investors, especially those heavily reliant on debt financing. Warren Buffett also shed light on another reason why the real estate market found itself in this predicament. He explains that many real estate investors prefer to buy properties with non-recourse loans. In simple terms, this means that the borrower is not personally liable for the loan. Unlike residential mortgages, where the borrower is responsible for paying back the loan regardless of what happens to the property's value, commercial property loans often allow borrowers to walk away if the property's value declines significantly. Buffett illustrates this with an example. Let's say a real estate investment firm buys a property for $50 million, putting down $10 million of its own money and borrowing the remaining $40 million from a bank with a non-recourse loan. If the property's value drops to $30 million and the loan comes due, the owner can simply hand the keys back to the bank and walk away, leaving the bank to absorb the loss. This scenario isn't just theoretical. There's an estimated $1.4 trillion worth of such loans coming due soon, and many properties are not worth what they were purchased for. As a result, a significant number of these properties are likely to end up in foreclosure, leading to financial losses for the banks that provided the loans. Buffett emphasizes that while this might seem like a problem mainly for large banks, it's actually smaller regional and community banks that have made the majority of commercial real estate loans. These banks may struggle to absorb the losses, which could have broader implications for small and medium-sized businesses that rely on them for credit. In conclusion, Buffett warns that there's going to be a lot of pain in the real estate market, and the question remains as to who will ultimately bear the brunt of it. Let us know what you think in the comments section. If you enjoyed this video, please like it and subscribe to the channel to enjoy more videos like this.